Today, we're exploring market entry strategies, which are essential for businesses looking to grow beyond their home markets. Specifically, we'll focus on navigating global business expansion, understanding how companies enter international markets successfully. Let's examine the four core modes of market entry that companies typically consider when going global. These represent the initial steps into international markets, each with different levels of risk and investment. First, we have exporting, which is one of the simplest ways to enter foreign markets. This involves producing goods in one country and selling them in another country through various channels. Exporting typically requires low investment and carries low risk compared to other entry methods. Companies can use direct methods by selling to customers or indirect methods through intermediaries. Next is licensing, where companies grant rights to use their intellectual property. This means granting rights to use IP or brand for a fee, allowing local companies to produce your products. This approach requires low capital investment for the licensor, making it financially attractive. However, there's always a risk of IP theft, as you're sharing your proprietary knowledge. Then we have franchising, which extends a proven business model to new markets. This involves granting rights to use business model and brand to local entrepreneurs abroad. It enables standardized operations and rapid expansion across multiple countries simultaneously. But companies face cultural adaptation challenges when bringing their model to different societies. Finally, joint ventures involve partnering with local companies in foreign markets. This means two or more companies form a new entity together to enter a market collaboratively. Partners enjoy shared risk and access to local knowledge that would be hard to gain alone. However, there's potential for cultural conflicts between the partnering organizations' approaches. Now, let's dive deeper into exporting, which offers low risk but high reach potential. Exporting involves producing goods domestically and selling them internationally, making it a common first step for expansion due to lower investment requirements and reduced risk compared to other strategies, with options for direct customer sales or using intermediaries, allowing market access without major foreign financial commitments, though distribution control may be limited. Next, we have licensing, which focuses on leveraging brand and intellectual property. Licensing allows companies to grant production rights to local partners for fees, enabling market entry without infrastructure investment, while generating royalty income and accessing local expertise, though it carries risks of limited marketing control and potential intellectual property theft or quality issues. Franchising enables standardized global growth through replicated business models. Franchising involves granting rights to use established brands and operating systems in exchange for fees, providing standardized operations with franchisor support and brand recognition benefits for rapid expansion with lower financial risk through royalty earnings, though daily operational control is limited and cultural adaptation is often necessary. Finally, joint ventures offer shared risk and valuable local insight partnerships. Joint ventures create new business entities through partnerships where companies contribute resources and expertise to share both risks and rewards, providing access to local market knowledge and enhanced market presence. Though cultural differences, control issues, and profit-sharing complexities can present challenges, let's explore the evolution of market entry, focusing on commitment and control levels as businesses expand globally. This journey takes us from minimal engagement all the way to deep integration in foreign markets. First, we have exporting, which is often the simplest way to begin international business activities. Exporting involves low risk and low commitment, making it an excellent first step into new markets. Next comes licensing, where companies grant rights to their intellectual property to others. Through licensing, firms earn royalties while maintaining relatively low commitment but gaining more market presence. Franchising represents another step forward in market entry strategies for business expansion. Franchising uses a standardized business model for rapid expansion with local partners, offering moderate control. Joint ventures involve creating partnerships with local companies in foreign markets. In joint ventures, companies share ownership and risk with local partners, requiring higher commitment and control. Finally, we have direct investment, which represents the deepest level of market commitment. Direct investment means full ownership through greenfield or brownfield projects, offering the highest control and commitment. Now, let's examine mergers, acquisitions, and strategic alliances as advanced growth strategies. These are sophisticated approaches that companies use to achieve growth and create synergy in markets. First, mergers involve the combination of two separate companies into a single new entity. In a merger, two companies come together to form an entirely new organization in the marketplace. The benefits include increased market share and improved cost efficiency through combined operations. However, mergers face significant cultural integration challenges that must be carefully managed. Next, acquisitions occur when one company purchases and gains control over another company. Acquisitions involve one company buying another to gain control and expand its operations. This approach allows for faster market entry and immediate access to valuable assets. But acquisitions carry integration risks and the potential danger of overvaluing the target company. Strategic alliances represent partnerships where companies work together while remaining independent. Strategic alliances are partnerships where companies collaborate while maintaining their separate identities. These arrangements allow for shared resources and reduced risk for all parties involved. However, they can create management complexity and the risk of becoming too dependent on partners. Let's compare greenfield versus brownfield investments for international market expansion. This choice involves deciding between building from scratch or adapting existing facilities. Greenfield investment means creating new facilities completely from the ground up. With greenfield investment, companies build entirely new facilities starting from scratch. This approach requires higher initial investment, but provides complete control over operations. The downside is that greenfield projects are time-consuming and carry higher risks. However, they allow for full customization to meet specific business needs and requirements. Brownfield investment involves working with existing facilities rather than building new ones. Brownfield investment means acquiring or leasing facilities that already exist in the market. This approach requires lower initial investment and allows for much faster market entry. The trade-off is limited control over the existing infrastructure and facilities. Companies may also face potential legacy issues with existing systems and processes. Now, let's discuss the key factors that influence market entry decisions for global expansion. These are critical considerations that every company must evaluate before entering new markets. First, companies must assess the market size and its growth potential in the target region. Understanding the competitive landscape is essential for positioning your entry strategy effectively. Cultural differences can significantly impact how your products and services are received. The regulatory environment governs what you can do and how you can operate in the market. Entry costs and available resources determine what strategies are financially feasible for your company. Finally, political stability and risk assessment are crucial for long-term success in any market. Let's examine some successful market entry case studies from major global companies. We can learn valuable lessons from how these global giants approached market expansion. Starbucks entered the Chinese market through careful adaptation and strategic planning. They used joint ventures to achieve local adaptation and understanding of Chinese consumer preferences. McDonald's successfully expanded into India with a tailored approach to the market. They implemented extensive menu customization through their franchising model to respect local tastes. IKEA approached the Indian market with a comprehensive strategy for product adaptation. They used greenfield investment to create tailored products specifically for Indian consumers' needs. Amazon entered India with a focused approach to e-commerce market development. They implemented e-commerce adaptation strategies through significant greenfield investment in the market. Walmart pursued expansion in India through strategic partnerships and modernization efforts. They focused on supply chain modernization through joint ventures with local Indian companies. Let's summarize the key takeaways from our discussion on market entry strategies. These are the essential points to remember about global expansion approaches and considerations. Market entry strategies vary significantly based on your objectives and risk tolerance levels. Exporting, licensing, franchising, and joint ventures each offer distinct advantages for different situations. Mergers, acquisitions, and strategic alliances provide more advanced options for company growth. Greenfield and brownfield investments present different profiles for control, cost, and implementation speed. Success in new markets depends on multiple factors including market size, culture, and regulations. Adapting to local market conditions is absolutely crucial, as demonstrated by global case studies.